Live from Tokyo, this is Insight with me, Jayant, where we dive deeper into the stories that matter with crucial context and analysis. Most Asian shares drop following a bruising session on Wall Street as fears around China's AI progress spark a sell-off. Nvidia losing $589 billion in market value, the most ever for a single stock. The dollar strengthens against peers after President Trump says he'll soon put tariffs on semiconductors, pharmaceuticals, and steel to bring production back to the U.S. We'll ask one of India's top steelmakers how they're bracing for that tariff impact. JSW Steel CEO Jayant Acharya joins us this hour. And higher commodity prices are a key concern for Pakistan's central bank governor. Jameel Ahmad speaks exclusively with Insight after cutting the benchmark rate to its lowest in almost 3 years. But our top story today, the reaction and market fallout from that Chinese startup DeepSeek. That's after the massive sell-off in U.S. stocks overnight as well. In the Japanese session here, we're seeing tech leading those declines, anything really related to chips. And Avril Hong is here to put this into perspective because, Avril, we're talking about $1 trillion of losses in U.S. and European tech stocks. I mean, this is massive.
It is. I mean, it's not just confined to the U.S., these declines, to your point. It's got ripple effects, ramifications in Europe, Japan markets, which I'll get to in just a bit. But really, at the heart of the matter is how, when it comes to U.S. stocks, they've been driven by this idea that nothing else comes close when it comes to AI technology services. You think about Nvidia, you think about OpenAI and Meta, and then now DeepSeek coming in and proving that it can do a lot for much less, a much lower cost. That's really upending the entire AI investment case and U.S. exceptionalism, perhaps. Nvidia, which is, of course, the poster child for AI, conversely, seeing the steepest losses when there is a rethink. And you look at the declines overnight, 17% down, the worst selling since March 2020. The declines worst on history in market cap, $590 billion in value just wiped out because of its heft in these benchmarks. We actually saw ripple effects for the major indices as well, and even fueled safe haven demand. Flip the board again, because it's not just about Nvidia, it's also a rethink when it comes to the Mag 7s. Can they justify their AI spending? Do they still have that pricing power? And you look broader when it comes to the S&P 500 valuations, that's still a near record premium versus the rest of the world. And these valuations don't quite account for the risk from competition. Now flip the board again, take a look at how these ripple effects spread through, because if you thought the declines for US tech ETF investors that they were hit hard, in Europe hit even harder, where triple leverage products are allowed. We saw the Nvidia ETP lose more than half of its $170 million market value before trading was halted. In Japan, Advantis is leading the losses. These two-day declines wiping off more than $8 billion in market cap, Sherry.
Yeah, really a lot of concerns about the rise of Chinese AI and its efficiency, also how it's really cost effective. And this rapid success for DeepSeek also putting a strain on the startup systems itself. Service briefly went down before new signups were limited to users with mainland Chinese phone numbers. DeepSeek says that the move was due to large-scale malicious attacks on its services. President Trump also weighing in on DeepSeek as well, speaking at a Republican Party retreat in Florida. Take a listen.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
Our next guest says DeepSeek's emergence may well prove to be the dot-com moment for the AI theme. Terri Spath is founder and CIO of Zuma Wealth. Terri, always good to see you. So do you think the bubble has burst now?
Oh, hi, Sherry. Wow, what a Monday morning we've all woken up to here in the United States and around the world. You know, Nvidia and the other AI-related names, just as you just previewed and talked about, were taken to the woodshed today. And this may well prove to be the dot-com moment for the AI theme and for the valuations that have accompanied that. They simply haven't been justified up until now, and now we know that they're not justified. And the good news is that some air really needed to be let out of the balloon, and a lot of air was let out of some balloons today. Nvidia is a dominant chip company. As a company, I think it's going to be okay, but this does raise a lot of questions about its valuation, a lot of questions about its market dominance, and that's because exactly what we just talked about. This new AI model costs a fraction of the price, completely disrupts the system. It's kind of the unknown that may be changing everything. And we think that, as earnings come out this week, it's going to be the topic that corporations are going to be asked about. Do you still need to buy a Ferrari? Do you still need to spend this much on CapEx? And the Ferrari meaning like the Nvidia chips of the world, and spending billions and billions on your infrastructure when you can do it cheaper and faster. And I think that's what we're really going to be watching as that spreads out through the market this week.
How important is it that big tech delivers this week then?
Well, I think it's going to be important that big tech delivers. I mean, everything's been, close to price to perfection, and we don't have perfection anymore. I do think that where we're going to be looking is not necessarily like, get out of Nvidia to buy Microsoft, but really the breadth that this, offers and forces people to look at in the stock market in particular. I mean, there's a lot of other stocks out there that haven't kept up with the same way, that have great fundamentals, that have nice growth prospects. And so, that difference between the PE ratio for the top stocks and the rest of the market has really gotten, it's created a big hole. And I think that can narrow, and that'll be something that we think could be interesting as the markets process all this information this week.
Does it also force investors to take another look at Chinese stocks? I mean, anything related to DeepSeek, as we see this parallel development of AI in the Chinese market? I mean, could we see animal markets returning there? Animal spirits, I should say.
Yeah, I mean, we've been asking ourselves that same question. We have been, pretty vocally negative on China, and there's other reasons for that. Just the growth, the economy, and the problems of trying to catch demand up with supply, I think is the bigger problem in China. That said, I do think some of the money that's going to come out of a lot of the, as you referenced, the U.S. exceptionalism growth names, and we will see that come out. I do think that could rotate into Asia. That's going to be kind of the growth, that opportunity for a lot of investors, not necessarily in China, although I think people will be sharpening their pencils a little bit more. But right now for us, we're still pause on that economy and the stocks within it.
And what about when it comes to companies adjacent to AI, how they utilize this new technology instead of having to invest so much in just innovation and building up artificial intelligence? Are you identifying some companies and sectors that could have more earnings potential, more business potential, just because of all of the benefits of using AI?
Yeah, I think I mean, that's the flip side of all this, is if we can do things more efficiently with AI, and we can do it a lot more cheaply, who's going to benefit from that? And there's a couple, common sense names that makes sense for. One is Apple, be a lot more productive and people using their phones. I think the other thing that this is really highlighting is the importance of open source for AI versus closed, which has been, I think, more predominant. We're really looking to the open source, and obviously Meta went in the direction of open source. That's looking very astute right about now. So I think that's why that stock held up today in a very red tape. So there are opportunities, really, as you said, in the adjacent market. One would be potentially Apple, another is Meta, but we're still not identifying those right now, so much as, hey, look at all the other opportunities that are out there if you were overexposed to Nvidia and you're looking to diversify a little bit better going forward.
Yeah. I guess diversification is the name of the game now that we're seeing these huge market volatility in some of these names. But when it comes to AI adjacent, you also like high dividend energy names. Tell us a little bit about your picks there.
Yeah, we do like energy. I mean, there have been a lot of investors. We're not in this camp necessarily that we're looking at the energy play as well. The companies that They're going to have to build data centers for all this AI that's out there. And there's going to be a lot of power that's going to be required to run these data centers. I do think that still exists, but just not with the sort of frothy excitement that had been there previously. So when we say we like energy, and we've liked this for a while, it's because we like the value that's represented in some of the higher dividend oil and gas names that are out there that are just, you know, nice cash flow, good value, pay a dividend, that kind of thing. If you don't have that in your portfolio, it's time to make sure that you've got that exposure and you really notice it on a day like today. And I think going forward, that's going to be the case as well, that you can't just kind of ride momentum and cross your fingers and hope that a day like this doesn't happen. Because when it does come, the pain is so awful that you really need to, you know, take a look at your portfolio and making sure that you're diversified into smart places, not everything, but into other places like energy, for example.
Terri, should we talk about the Fed? I mean, when did the FOMC become an afterthought in a week like this? Given, of course, also the news flow coming from the Trump administration with potentially inflationary tariffs, how do you position in terms of sort of identifying the pace of easing that we might see from the Federal Reserve?
Right. I mean, that used to be kind of the big news item of the week. I'm glad you reminded me of it. The Fed is meeting this week, that they will pause in terms of, you know, cutting interest rates. I think has been pretty well advertised. We don't expect them to cut rates this week, but we do think that the direction of travel for interest rates in the United States is unambiguously still down. You know, the other, I think the ECB will also be meeting this week, and we do expect for them to cut. And I don't think that's, you know, a bold statement. I think that's widely expected. But we will look for hints on their path going forward and whether, you know, what they intend to do. And that could be a potential tailwind for really, really cheap stocks over in Europe. The investment implications, though, on a Fed decision, or I guess our view that rates are going to continue to go down at the short end of the curve, is that we do expect steepening of the yield curve. Now, we saw longer rates as a flight to safety today. People buy bonds, it pushes up the price, it pushes down rates. But overall, we think this trend to steepening will continue here in the for the U.S. Treasury market, and that's benefits financials. And so we like financials as well as energy stocks as places to redeploy cash for investors.
Terri Spath of Zuma Wealth, you're sticking around. We do want to talk to you more, especially about the implications for markets coming from all of these tariff headlines. But we're getting more reactions also from Silicon Valley on DeepSeek. In a statement to Bloomberg, Meta now saying that it wants the U.S. to continue being the leader in open source AI rather than China. It also says open source models are driving a significant shift in the industry and will bring AI's benefits to everyone faster. OpenAI CEO Sam Altman also saying that DeepSeek's R1 is an impressive model. Still ahead this hour, we get reaction to President Trump's latest tariff threat with Jayant Acharya, CEO of JSW Steel. We'll also discuss their third quarter profit miss and the outlook for global demand. Much more ahead. This is Bloomberg. The Japanese yen accelerating losses against the U.S. dollars. We're getting breaking news right now on the composition of the Bank of Japan. The Prime Minister Ishiba's government has now nominated Junko Koeda of Waseda University to replace Seiichi Adachi on the BOJ board. Ishiba's BOJ pick would put two women now on the board of the Bank of Japan for the first time. Remember, Seiichi Adachi is perceived as more of a dovish member of the board, and he's seen condition meeting for normalization. Right now, we're getting the latest that Koeda has been officially appointed, and she will now join Junko Nakagawa as the second woman on the 9-member board of the Bank of Japan. Right, of course, the Japanese yen also reacting to all of the political news, especially around President Trump, that now says he wants universal tariffs on U.S. imports to be much higher than 2.5%. This is, of course, after an earlier FT report that his newly confirmed Treasury Secretary Scott Bessent is pushing for the smaller number. Trump earlier also promised tariffs are coming soon, covering goods from semiconductors to metals. Let's get more on the president's latest trade broadsides with our senior editor, Derek Wallbank. Derek, so what exactly could we see in terms of these universal tariffs?
Well, it has been a question of when Donald Trump might go forward with these, as well as to what degree, right? We had done some reporting 2 weeks ago that had suggested that there might be a gradual range for these, starting maybe in the 2% to 5% level and then working it their way up. There was an FT report that got some big attention in the morning that said that Scott Bessent might want to start at 2.5% as sort of an opening place and then go from there. And then we put that question to Donald Trump aboard Air Force One. He told reporters there he was looking at something much higher than 2.5%. He said that he didn't think that that was where Bessent wanted to be, and that's not where he wanted to be either. In addition to that, Trump has also been talking. He was telling House Republicans at his Doral golf course resort in the Miami, Florida area that he was looking at specific tariffs to different industries, some metals, some semiconductors, pharma. He heavily hinted at the idea of tariffs, maybe even on auto plants that are in Canada and Mexico, just across the U.S. border, trying to get some of that into the U.S. So Trump, he held off on immediate tariffs right at the start of his now second presidential term. But any thought that that might be, some sort of stowing away seems to have gone away with this now much fresher threat with a lot more detail on it.
Do we have any sense of the tariff timeline now that we have Scott Bessent finally confirmed as Treasury Secretary just today?
We don't really have a great sense of a timeline for when these sorts of things would come on. Trump actually said that he had an idea for what the tariff level might be, but he wasn't ready to do it just yet. That doesn't really tell us exactly what the level is, and it doesn't really tell us exactly what the timeline is. But I do think that you're looking at a president right now who is a little bit more emboldened than he was. The weekend issue with Colombia, a very big U.S. Friend and partner in the Americas, Trump had a difficulty getting some of his deportees in a migrant flight down to Colombia. That got scotched partway through. Trump immediately going with a fresh volley of tariff threats. Colombia backs down, and at the end of that, Donald Trump sits there and says, essentially, his administration says to themselves, right, this works. This is a playbook that can work. And so I think both as a policy but also as a threat, you see this White House quite emboldened.
Senior editor Derek Wallbank there with the latest on those tariffs coming from the Trump administration. Terri Spath is still with us, founder and CIO of Zuma Wealth. Terri, thanks again for sticking around. It was interesting to hear Derek talk about those tariffs against Colombia, given how friendly the U.S. and Colombia are and how strong that relationship is. Is there anywhere in the markets, in regions, to take cover right now from that potential implication of duties?
Well, that was very interesting reporting from Derek. And Sherry, thanks for having me back on, because this is a really interesting topic as well as these tariff announcements and the Trump administration sort of, I guess, novel approach to using them to extract non-trade concessions. So the thing that happened with Colombia was a non-trade concession. It was about immigration policy. And what we are seeing right away in the Trump administration is that they're not afraid to go big on threats. And it, like Derek pointed out, it seems to have worked for what the administration was looking to achieve. And so this will be an interesting, I think, news stories, these tariffs, as to how they're going to be utilized to extract certain, like I said, non-trade concessions. but they won't necessarily have an economic impact, even though they might push markets around. So it'll be, I think, a lot of news, but not necessarily economic implications every time we hear a new tariff policy coming out of DC.
We have seen the first Trump administration, though, see that economic impact, especially when it comes to consumption and the potential that we could be heading towards a U.S. economic slowdown, not only if we do, in fact, get all of these levies on products that are coming into the United States. Is this a concern for you, or do you still believe in American exceptionalism when it comes to the strength of the economy?
Well, I mean, okay, there's a lot to unpack in those questions. So first and foremost, I mean, one of the things that we've seen and we saw in the prior Trump presidency is going hard with tariffs. And I think that it's important, and we've said this before, to take Trump seriously, but not necessarily literally, as we just discussed with that 2.5% number. But certainly he's going to use this as a big stick. I think what we were surprised by in the first couple of days of this new presidency is that Trump is really going hard on Canada. He's really going hard on Mexico, not so much on China. So how does that play into things here in the U.S.? We do think it's a low probability, but it's not a nil probability that there can be a recession here in the United States. And that could be triggered by a combination of things, one of which might be tariffs. And I do, kind of separately from that, I think the Fed is wrestling with like what's going to happen in the next 6 to 12 months with policy, how are tariffs going to impact inflation or consumption or the jobs market. And I think that they're trying to figure out, what that's going to necessarily mean for the economy. So it's certainly, I think, the most important kind of set of policies coming out of the Trump administration is going to be what's the latest tariff stick that might be brandished and the implications for the U.S.
The first reactions usually when we see trading headlines is in the currency space. Given the strength of the U.S. dollar, how are you really factoring that into your portfolio allocations? Well,
I mean, it's hard to figure out. I do think that the dollar's, going to be a little bit strengthened if rates stay kind of where they are, which they're going to probably do going forward. In terms of like how we're positioning our portfolios, it's, we can't predict necessarily what's going to go on inside the Beltway, and we can't react to it on a day-to-day basis. So when we're looking at our client portfolios, what we're looking for right now is, it's to pay attention to what's going on with this bull market and the momentum or loss of momentum that we're seeing currently, but making sure that we have exposure to energy, making sure we have exposure to financials. And when we look internationally, we've been constructive on Japan for a while, and we're also starting to take a look at India again. I think that there's growth potential that's going to come out of there. It's been a little bit forgotten, and I think that there's going to some of this growth money is going to need to go somewhere. So that's kind of how we're positioning in the kind of shorter to medium term for our clients.
Terri Spath, always good to talk to you, founder and CIO of Zuma Wealth, as we head towards that market opens in India. But coming up, more tariff threats issued by President Trump, this time on steel, aluminum, and copper. JSW Steel CEO Jayant Acharya joins us next with his insights on the sector's growth outlook. This is Bloomberg. Shares of SoFi Technologies sank after the fintech lender's profit forecast missed expectations. CEO Anthony Noto joined us to discuss their earnings results and also plans for more investment to drive growth.
Two things. One, 2024, we took a pretty conservative approach to the year in terms of our growth and our profitability. We really wanted to make sure that we were able to drive strong profitability in 24 to achieve GAAP profitability, to ensure we reinforced our balance sheet and a capital cushion, and we did just that. Prior to 2024, we had committed to a balanced approach to growth and profitability, where we would reinvest 70 cents of every incremental revenue dollar, and we call that 30% incremental EBITDA margins. So we took our revenue forecast for 25 up. We're in the best position we've been since I've been here at SoFi for the last 7 years. We're calling for 25% revenue growth, strong margins at 26%, just not an expansion in the margins, because we want to invest in the massive opportunity that still sits in front of us. And so we took revenue guidance up, and it's about 10% higher than the street, but that will require more investment, and it'll help us ensure we have growth beyond 25. And we also took our revenue guidance for 2023 to 2026 on a compound annual growth rate basis higher as well. So the profitability of the business is there. We could drive more to the bottom line, but we think that's not the prudent thing to do, because we just see massive growth in front of us, and the ability for us to keep driving member growth and product growth of more than 30%, which we've done, and revenue growth of more than 25% is what we're calling for through 2026.
Anthony, the investment that you just described, what portion of it will you be putting toward artificial intelligence? It's the topic at the top of everybody's minds, and people are watching how companies are deploying it. Do you see, for instance, an agent-driven service perhaps at SoFi at some point?
The vast majority of our investment going into 2025 and 26 will be in building unaided brand awareness, becoming a trusted household brand name. We have great products. The reason why we're driving such strong product and member growth is because the products are very differentiated. And when we make people aware of them and they use the products, they not just use the first one and they gain trust with us, they use the second and third one. 30% of our product growth in the quarter of 34% was from our existing members. About 40% of our members take out a second product within 30 days. So we'll continue to invest in differentiating the product. SoFi Money is a great product that has a high APY. You can do person-to-person payments. You could do Zelle, auto bill pay, 2-day early paycheck. And so we'll be investing in that. We'll be investing in our Invest product to expand the selection for Invest, in addition to other product categories like insurance and credit card and small and medium business lending.
SoFi CEO Anthony Notos there, speaking with Bloomberg's Michael Shepard. We do have more ahead on Insight. This is Bloomberg.
The only way you'll get out of this is to build your plant. If you want to stop paying the taxes or the tariffs, you have to build your plant right here in America. That's what's going to happen at record levels. We're going to have more plants built in the next short period of time than anybody ever envisioned before, because the incentive is going to be there, because they have no tariff whatsoever. In fact, they have help from us if they build their plant in America. And we're going to look at pharmaceuticals, drugs. We're going to look at chips, semiconductors, and we're going to look at steel.
President Trump there continuing to wield the tariff stick. He said that he was considering tariffs on everything from semiconductors to steel and copper. Take a look at commodities trading really under pressure throughout, especially after we saw 3 weeks of losses for copper already. Of course, there are concerns about demand given that Chinese factory activity has also contracted in January ahead of the Lunar New Year holidays. Joining us now is Jayant Acharya, CEO and Joint Managing Director of JSW Steel. Jayant, really good to have you with us, especially on a day like today when we continue to hear about tariff news. I know that we don't have the details when it comes to steel tariffs from this administration, but given your experience in the first Trump administration, how are you bracing for impact?
So thank you very much. The geopolitical landscape has been very challenging in the past few years. And I think the new policies which the Trump administration would announce needs to be watched. Any changes in policies which would impact tariffs is likely to escalate trade tensions, and that could impact supply chain. That could be a drag on the global growth. We do expect some tariffs which would be levied. However, as far as steel is concerned, I think as far as India is concerned, there are already tariffs in place. Most of the countries already have safeguards into the United States. So there is hardly any exports from, let's say, India to US. It may impact certain other countries, but I think China's direct exports of steel is also limited. we'll have to wait and watch how the tariffs play is announced by the Trump administration.
Give us an understanding of JSW's business with the United States, because we know that you have a subsidiary, that you have a plant. Are you planning more investments in this environment? How much do you export as well?
Yeah, so we have two facilities in the United States, one in Ohio and one in Texas. We have been investing into those assets over a period of time. We are investing to upgrade certain facilities to be able to provide steel for oil and gas and steel for the wind. We will have to see how the policy on the fuel and the energy plays out. I'm sure oil and gas will continue to be strong as the Trump administration has guided. On the wind side, we will have to wait and watch. My feeling is whatever projects have been taken up under the IRA or otherwise will continue to be there. If there is a change in policies going forward on wind, especially onshore and offshore, that is where we may have to calibrate a little bit of the investments which we're doing in our facilities at Texas. As far as exports from India to the United States is concerned, it's hardly there. It's close to zero. Our exports from India to the world is very limited. 92% of our business last quarter has been domestic. So luckily the country, India, is growing very well. So we are happy to be focused more on the Indian business.
Are there concerns for you that if we do see these tariffs, especially more onto Chinese steel, that you could see more flooding into the India market, and that would, of course, hurt your business?
That is very true. I think last year, China did see very high exports, close to 120 million tons. A weaker domestic market and I would say relatively higher production continue to encourage exports, which has dampened the steel prices globally. We are seeing stimulus measures which China is trying to take. I would say these are early steps and we need to see how it plays out. There is a moderation in production last year, and there is an expectation that production may moderate in this year also by about 2%. So with an improved domestic environment, in case the stimuluses are effective, and a lower production, hopefully will reduce the exports. But the exports coming into India is a challenge, and we have seen a very high level of imports into India. Unfortunately, we are the fastest growing major economy in the world. We are vulnerable since we do not have any trade barriers in place. We are looking at a level playing field, and I think adequate steps would be taken by the government to see that level playing field is provided.
That 25% safeguard duty that's being proposed by the Steel Ministry, for example, is already being reviewed by the European Union right now. What do you expect the impact to be on your business, and what would you say to people that think that this would be impractical to implement?
In Europe, did you ask about the European side?
Yeah, the safeguard duty of 25% that India's Steel Ministry is thinking of.
Okay. Yeah, so I would say that if you look at the safeguard and tariffs which the other countries have put, United States has got a 25% safeguard for many, many years. Europe has a safeguard of 25% with the tariff rate quota. Canada has a safeguard of 25%. And many other countries have got various anti-dumping and trade measures in place. As a result, what's happening is that most of the steel from China is getting diverted into other countries, especially Asia, and India becomes more vulnerable. Whether the duty or whether there is a positive view on the trade investigation remains to be seen. But I think what needs to be looked at is fair trade. We would not like cheap steel or unfair trade to come into India. And that is what we are looking to arrest. Otherwise, as a country, I think we have a very positive trajectory in the medium to long term. And the steel demand in India is growing very well.
Tell us a little bit about India's demand, especially in terms of what you're expecting to see in capacity by 2030.
Yeah, so India today has a capacity of about close to 190 million tons. We are the second largest producer and consumer of steel in the world. Last year, the demand of steel in India grew by 11% or so in the financial year in 9 months. We expect the demand to be touching 150 million tons as we close the financial year in March, which is an incremental growth of 14 million tons. So India is actually contributing today to the major demand, incremental demand of the rest of the world. So many other countries are actually slowing down, and India is adding to the incremental demand of the world. Going forward, a very strong infrastructure pipeline, a very strong focus on manufacturing, growth in the hinterland, the rural side activities picking up based on physical infrastructure, social infrastructure, communication network, and that all aids a very rapid growth in steel demand as well. So we are very positive. We are looking at 300 million tons or so in India, and the demand should go up from here by close to 80 to 100 million tons by the end of the decade.
And yet your business itself, we continue to see the pressure on profit growth, especially given weaker prices as well. How do you plan to overcome this, and could it actually delay some of your projects as well?
Yeah, so from a cost standpoint, we are taking various measures to reduce the cost at our end. We are also expecting the raw material cost to moderate. That would play into the profitability metrics. Our volumes are growing because our 5 million ton facilities have just been commissioned, and those will ramp up in the coming quarter and the year ahead. So our absolute volumes will increase, and we look forward to a better quarter and a year ahead.
What can you tell us when it comes to that venture that you have going on with POSCO? I mean, more Korean steelmakers and companies want to enter the Indian market. Do you have an idea of when production could start with the joint venture as well, and what the plans are from here?
Yeah, so India, as I mentioned, is a growing country, and there is an interest from many foreign players to set up facilities in India. We have discussed with POSCO the possibility of setting up a facility together. We are looking for land and facilities in the states in India, especially where iron ore is located. And I think it will take us a month or two to identify the land, and then we should be able to start the joint venture activities. So it will take after that about 3 to 4 years to get the facilities on ground.
And before we let you go, Jayant, just to clarify your investments in the United States, when you talk about sort of changing or adjusting, are we talking about more investments and more hiring that could potentially help with getting on a good foot with the Trump administration? Or are we thinking about resizing and just perhaps making it smaller, given right now the challenges and risks that economy could face with the levies?
So currently our expansions and investments in Ohio, about $145 million is already on. In Baytown, close to the second phase of expansion, about $110 million is on. So these two investments put together, about $250 million is in progress. The Ohio investment will carry on. The Baytown, Texas investment is something which we may have to calibrate the product mix going ahead in case the wind projects are directionally changed. So I think our focus will continue to see how to align these investments better to be aligned more to the growth which United States is likely to see in the coming years.
Jayant Acharya, really good to have you with us. He's joint MD and CEO at JSW Steel, of course, on a day with plenty of news coming on potential tariffs and just the volatility in the commodity space. We're also following Pakistan because the central bank has just cut its benchmark interest rate to the lowest in almost 3 years. This, as we're seeing now, cooling inflation, giving some wiggle room for officials to support growth. Bloomberg Economics says the 100 basis point move to 12% is probably the last cut until at least December, as inflation is expected to pick up again in the coming months. But let's actually get more details and that outlook from the governor of the State Bank of Pakistan himself, Jameel. Ahmad joins us now. Governor, really good to have you with us. I just want to get started with sort of your reasoning behind this cut, given that, just as I was speaking to Jayant, these tariffs, changes in the Trump administration could lead to more inflation.
So good morning, and thank you very much for inviting me to your program. I think we yesterday had a monetary policy committee meeting, and the committee decided to cut the rate by 100 basis points. And with this cut, we have now cumulatively decreased the policy rate by 1,000 points since June last year. And we have seen that the reviewed the recent developments in the economy. And we have, based on the favorable trends in external account as well as in the inflationary trends, have decided to make this cut. We have been reviewing this position from time to time, and I think we are now confident that given the current situation, we were in a position to reduce this rate because of the reason that the headline inflation last month in December was 4.1%, and although the core inflation is slightly elevated around 9%, but still it was well below the last policy rate cut in December of 13%. Right. So,
given the inflationary
yeah,
go on.
So I think we also have to take into account that our inflation, which was 38% in May last year, in May 2023, has sharply come down to 4.1%, and with that we have ample room to cut. Our real interest rates going forward are also in the short term quite positive, and that also is providing us flexibility for the rate cut.
When you talk about ample room to cut, does that include the rest of the year, given, of course, inflationary concerns that I mentioned already? You flagged commodities pricing could be an issue in the future with tariffs on some of these commodities. Could that change your calculus?
Yeah, we have reviewed the commodity prices and the global trends also, particularly on the oil prices, because we are oil importing country, and also we are importing many other commodities also. So given the current level of price and also the future outlook, I think we have ample room, and we already have a very conservative prices inbuilt in our forecast. And when we look at the current account, also already we have a surplus of $1.2 billion for the last 6 months, and from July to December. And also, as compared to $1.4 billion deficit, which we have in the comparable period last year. So, so still we are not facing at this stage any pressures as far as the external account is concerned, and that has also gave us confidence that we can review the policy rate and revise it slightly downward.
And does that also mean that you're not too concerned about the level of the rupee? Where do you see it by the end of the year?
Yeah, we have obviously have been reviewing the trends in the currency markets also, and currency for the last more than a year now is quite stable and hovering around 278, 279 rupees per dollar. And since the underlying factors which can influence the currency are also providing a favorable environment, so taking that into account, and also the operations of the open market, which used to be having a very wide difference between the interbank market and the open market, but currently both the markets are trading in a very narrow band, so and there are not much differences between the rates in the two markets. And also we have done a lot of work on controlling the smuggling, and also improving the performance and the working of the exchange companies, and that has provided us I think good monitoring framework also from the oversight perspective from the central bank side. So so all that has a positive impact on the currency markets, and we don't see any pressure. Also, as I mentioned earlier, also that there is a surplus, high level of surplus during the last 6 months, and given the current level of reserves also, which we have built in during the last 1.5 years, and which are at a reasonable level of more volumes of imports. So all that is providing basis for the stability of the currency.
Yeah, especially when it comes also to those debt payments and the conversations with the IMF. You seem confident about the review coming up, but at the same time, I do wonder if you have any concerns about this new Trump administration and pressure on the IMF when it comes to really trying to help debt relief in Pakistan.
So we have been reviewing the impact on our trade also, since we are one of the economy which is import dependent also, and also we have exports level also to many European and US markets also. So we have reviewed the impact of any protectionist policies, any trade barriers, and I think at this stage we are comfortable that it will not have any major negative impact on us.
When it comes to the debt rollovers, for example, from countries like Saudi Arabia, China, UAE, could you give us an update on how they're going and if you'll need to do more this year?
So on the rollovers total for the current fiscal year, we have total repayable amount of $26.1 billion. Out of that, around $16 billion was expected to be rolled over, including $12.3 billion of bilaterals and around $3.7 billion of commercial bilateral loans. So far, all due rollovers have been due maturities have been rolled over on time. Already we have $7.3 billion rolled over on the bilateral side, and also there will be $5 billion more, which will be rolled over during the remaining of the current fiscal year when they become due. And we don't see any problem because
Jameel, Ahmad?
Yeah,
continue.
Please.
Yeah.
So we don't see any problem as far as the
running out of time. Jameel, Ahmad, thank you so much for joining us. So you're telling us that there will be no problems in rollovers of debt in the future. Governor at State Bank of Pakistan, really good to have you with us on your insights after that rate cut to 12%. We are seeing the markets right now broadly in the negative, with tech leading the declines. That's it for Insights. Horizons Middle East and Africa is next. This is Bloomberg.